Today, we're going to dive into a really fascinating idea. Can you actually map out a market's next move ahead of time? We're going to follow a single, publicly documented trading cycle on the Nasdaq 100 from the Market DNA framework, just to see how close a pre-made plan really came to reality. We'll look at the map, the pretty wild journey it took, and of course, the final destination. Let's get right into it. And this really is the million-dollar question, isn't it? Can a market's path truly be mapped out in advance? We're about to see what happens when a pre-drawn map meets the, unpredictable territory of the real live market. So let's start with the plan.
All right, first up, the cycle setup. This is where we look at the blueprint. This is the exact plan that was put out there before this cycle, which they called US100 cycle 3, even began. So take a look at this. This right here is the map, as it was published on February 1st, 2026. So before a single trade was made, this chart laid out all the key battlegrounds, specific price levels to watch, and even a predicted time frame for the whole move. This is our baseline, the starting point for this whole journey.
Now, to keep things simple and easy to track, the entire cycle was based on a hypothetical starting capital of $100,000. It just gives us a nice clean benchmark to measure performance against. And of course, with that kind of capital, you've got to have rules. The maximum loss, or what we call drawdown, allowed for this cycle was set at 5%. That's a $5,000 risk limit on our hypothetical capital. That was the absolute line in the sand, no questions asked. Okay, let's get into the specifics. The plan pinpointed a primary entry point, labeled the M level, and also a potential backup entry at that P level. From there, it laid out 3 different profit targets, with the final prize being the top of that trapezoid structure you see, at over $26,000. And you might be wondering, well, how much should be traded? It wasn't just a random guess. The documentation is really clear that the position sizing was systematic, all based on a specific formula. It says, and I'm going to read this directly because it's pretty technical, both trade sizes are calculated using the hypothetical capital, the maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. The main thing to get here is that this was all run by a strict rules-based system. So the map was drawn. But as we all know, the market, it has a habit of taking detours. In this next section, we're going to see how this whole journey went completely off script. Okay, this is where it gets really, really interesting. Normally, you'd expect a simple sequence, right? Phase 1, then 2, then 3, then 4. Easy. But nope, that is not what happened here. The actual path was a total scramble. It kicked off at phase 1, then jumped way ahead to 3, fell back to 2, and then finally somehow made its way to 4. And here's the first big plot twist. Just one day into the cycle, on February 2nd, the price suddenly surged and hit a key price target. This triggered the completion of phase 3, even before phase 2 even had a chance to get started. I mean, this just threw a total wrench in the plan. The source documentation from that day actually asks the question, will the next phase be phase 2? We are navigating the market to see what happens next. It really captures that feeling of trying to track this thing as it's all unfolding in real time.
And the answer, well, it didn't come quickly. It wasn't until February 25th that the price finally pulled back and completed phase 2. But just think about that for a second. It happened after phase 3 was already in the bag, and it was 5 days late from the original time window. The market was definitely taking its sweet time.
The final piece of this puzzle finally fell into place on April 15th. The price hit the top of that trapezoid, completing phase 4. All the positions were closed out, and the cycle was officially over. And just like that, the journey was complete. So the journey's over. Now it's time for the big comparison. Let's put the original plan right next to the actual results. This is the map versus the territory. Let's break these numbers down. The final return, surprisingly close to what was predicted, 1.32% realized versus 1.39% expected. The risk was also managed really well. The actual drawdown was only negative 3.73%, staying comfortably under that 5% limit. But here's the real kicker. Look at the time. The plan called for 19 days. The reality, 72 days. So what does that look like in good old dollars and cents? On that $100,000 hypothetical capital, the total profit that was realized was $1,317. And honestly, this might be the most important takeaway from the results. Despite that wild roundabout path it took and the much, much longer time frame, The portfolio's biggest dip was only negative 3.73%. It never, ever breached that 5% risk limit. The system's guardrails held up.
Okay, so now let's zoom out. This one cycle is just a single data point, right? But the research suggests it's actually part of a much larger repeating pattern. Let's see how this one little piece fits in to what the framework calls a fractal. So what you're seeing here is basically a zoom out in time. On the left, that's the market structure at a stage the research calls fractal 2. Then on the right, you can see how that very same structure evolved and expanded into what's called fractal 3. The big idea here is that these larger patterns are developing in a consistent, observable way. The framework has a name for this whole thing, the fractal cycle evolution, and it breaks it down into 3 stages. First, you've got fractal 1, or encoding. That's where the initial map gets drawn. Then comes fractal 2, development, which is when the market is just kind of moving around inside that map. And finally, you get fractal 3, activation, which is seen as the final window for the cycle to complete its move.
And this brings us right to the core hypothesis of the research. The idea is that this fractal 3 stage is the critical activation window. It's the point where all the time and structural pressure that's been building up finally gets released, causing that big directional move that completes the whole cycle. So, what's the final verdict from the researchers themselves? Well, the source material is very, very careful here. It states that they've observed a recurring pattern and that this fractal 3 stage seems critical. But, and this is a big but, it really emphasizes this is an ongoing observation. It's not some proven law of physics, and a lot more data is needed.
All right, before we wrap up, it is absolutely essential to go over the official disclaimers. None of this is financial advice. It's an explanation of public research. The framework itself prohibits using high leverage, and it warns against investing essential personal funds.
And that wraps up our deep dive into this Nasdaq 100 cycle. It's a pretty compelling case study on the attempt to map market structure in advance. If you want to dig into the data yourself or maybe explore some other cycles, all the original documents are available over at marketdnaedge.com. Thanks for joining me.